Watch his exceptional story, Pursuits by Skoda, only on Bloomberg Quint.
Hello and welcome. You're watching Countdown. The portfolio allocations are out. India has its second woman finance minister, Nirmala Sitharaman. BJP party president Amit Shah has been given home, while Rajnath Singh gets defense. So what should one make of these allocations? Kaushik Vaidya is joining in right now with a detailed bifurcation of the same. Kaushik.
Let's take you through the background of each of these top ministers in the second Modi cabinet, starting with Finance Minister Nirmala Sitharaman. Remember, she entered the first Modi Council of Ministers as Minister of State for Finance, Corporate Affairs and Commerce under Arun Jaitley. So she has had experience in the finance ministry in the first few years of Prime Minister Modi's first term. Moving over to Home Minister Amit Shah. He's been party president for the last 4.5 years. Before that, when Narendra Modi was Chief Minister of Gujarat, remember Amit Shah was Home Minister under him in the Gujarat cabinet between 2002 and 2010. Moving over to Rajnath Singh. Rajnath Singh is India's new defense minister. Before that, for the full tenure of Prime Minister Modi's first term, Rajnath was Minister for Home Affairs and second in command in the Modi cabinet the first time round. In the External Affairs Ministry has been this cabinet selection's biggest surprise. Former Foreign Secretary S. Jaishankar is now India's new Foreign Minister. Remember, he was Foreign Secretary at a time when Prime Minister Narendra Modi was shaping his foreign policy, and along with National Security Advisor Ajit Doval played a key role in shaping the Modi doctrine in the first 5 years. He was also ambassador to the United States, to Singapore and to China. Each of those relationships, China and the United States, are key for Prime Minister Modi to shape how India interacts with the rest of the world. Nitin Gadkari has retained his core portfolio of road transport and highways. This is something that Minister Gadkari put focus on in the first 5 years. Even before that, between 1995 and 1999, Mr. Gadkari was the PWD minister in Maharashtra. The crucial portfolio of agriculture has gone to Narendra Singh Tomar. Mr. Tomar is a senior functionary within the BJP. This is an area where in the economy will need some new focus and some new policies to get out of the current state it's in. Piyush Goyal, who briefly served 2 stints as interim finance minister, has retained his railways portfolio and has now taken over as commerce minister from in the outgoing cabinet. Remember, Suresh Prabhu had served as commerce minister. Ravi Shankar Prasad has retained his portfolio of law and justice. He retains his portfolio of communications and the electronics and technology department. That pretty much is your core team that will serve along with Prime Minister Narendra Modi as India's cabinet right now.
All right, Kaushik, thanks very much for that. So that's the setup for us in terms of what kind of allocations and what is the design of this ministerial portfolio allocation that has happened this afternoon. Let's welcome Ajay Srivastava of Dimensions Corporate Financial Services. He's joining us right now on the phone line. Ajay, what have you made out of these ministerial allocations?
Well, I think first of all, of course, everybody thought it's a surprise, the finance minister. But I think it's a good move because she comes with a background of a commerce ministry where exports are struggling. She comes with a good background of what's happening in the defense production, which can be the big bulwark for economic development of this country. So she understands what the problems are. She understands what is required to that extent and get the finance ministry rolling on that aspect. So I think from the exporter perspective, defense companies perspective, I think it's a great positive that someone who knows the intricacies of the department is sitting in the finance ministry. Of course, a new portfolio, it will be challenging for her. Economy is not doing well. And so for some new thinking is required. To that extent, there is a great challenge. But I think exporters and defense production companies should feel easy today that someone who knows the problem is now sitting in the finance ministry.
What do you think is going to be priority? There is a list of things that obviously the new finance minister has to probably take a look at, getting the economy running again, around capital infusion, the NBFC issue, the liquidity problems that we have, getting the exports back on track, which had dipped to about 28.9% of the GDP from 30.1% in FY15. So all of these aspects, need to be looked at. What do you think is going to be priority for her?
I have a different view. I think they will look at a very different set of priorities. I think they will going to look at rural distress first. They're going to look at the drought situation in the country second. farm prices third. My guess is that, we may clamor what we want to clamor about industry and NBFC, etc. But that would be P2 for this government because this has come with a huge mandate. The mandate has come from war and widespread. And number two is there's not much the government can do. It's an RBI which can open the spigot of financing. Government can't open a spigot for RBI. So I'm not sure whether the finance minister can do very much on this side or may even want to do it. I think the bigger priority is going to be the big constituency of the rural India, which is under distress, the drought conditions which are acute in most parts of the country, and therefore industry might be well a little surprised to find that their requirements are P2 and not P1 in the priority for the finance minister.
Ajay, there is status quo when it comes to the road portfolio as well as the oil and gas portfolio where Nitin Gadkari and Dharmendra Pradhan respectively hold their places. Any changes that you expect them to make and how do you see the continuation of these heads with their respective portfolios?
I think, of course, the petroleum minister being the same minister being there, I think you can expect those policies being carried forward across the country, which is the Ujwala Yojana and other and that gives a little bit of a problem for the OMCs, whether they'll be able to operate on a market dynamic altogether. So I think a little bit of excitement in OMCs could be now subdued. That will they be used to now do subsidized supply of liquefied gas or petroleum to the rural part of the country. I think it's a little bit of a negative to that extent. But having said that, highways is a great story because I think Mr. Gadkari did a fantastic job. So did Mr. Pradhan did, to be honest, about getting the cylinders to the rural India. So I think it's a good continuity. Highways should be, and good part is that Nitin Gadkari identified that the schemes of having private participation is not working, and therefore we need to move to tender contracts. I think that is a great move, and that should accelerate now. So I think it's a very good move for the cement companies by and large. EPC companies may not be so much because their margins are very narrow. So we will not see too much of that. But to that extent, I think for cement companies, great positive, he's still there, and he will launch projects in government funding more than private sector funding. So you can see lots of highways coming up, I think, in this new tenure and much faster than even the past one because I think everybody is coming back with a lesson that economy has slowed with whatever they did last year. So they need to do something drastic, and the drastic easiest thing is to build highways with government money. So all power to him. He's accepted the model of government building highways, and therefore we are very happy that he continues.
Okay. The other part is the MSME portfolio that is under Mr. Nitin Gadkari, and he being the proactive leader that he is, do you see a big meaningful changes happening within this sector? Because this is a sector which has been plagued by lack of liquidity, the growth out there has been sputtering. So do you think anything big can happen for this segment?
I doubt it. I'm sorry to say the news, but I doubt it anything big can happen because the problem of MSME comes not from the Ministry of MSME, but it comes from somewhere else altogether. It comes from the fact that financing, as you rightly said, is not available and the demand is not there. When GDP grows at 6%, there is no hope for the MSMEs to have demand of their products. If like automobile is going down to negative territory, so what do small ancillaries going to do? They're going to shut down at the end of the day because the car companies will say instead of buying from 5, I'll buy from 3 now, which will give me better cost economics. This is a problem which is not going to be industry-driven in terms of the ministry-driven MSME because the rules of MSME itself are so drastically against the MSMEs. So 45-day payment, penalty for people who don't pay, 18% interest if you don't pay MSME in 45 days. So that is what is killing this industry. So really, I doubt very much could happen to MSME till the economy moves up or till the RBI moves in terms of funding. I'm not very sure what he can do except take out every restriction on MSME, the 45-day payment, 18% interest, compulsory issue, penal liabilities for people who buy from MSME cannot pay. All these is harming MSMEs more than gaining traction for them. If he can do, I think he'll do a great service, but I doubt that very much can happen in the short run.
Okay, Ajay, we'll leave it at that. Thank you so much for giving us your take on the new cabinet formation. That's Ajay Srivastav of Dimension and telling us about how the markets can play out in the sector specifically in the light of the news developments that we have with respect to the cabinet. But let's move in and get in another expert. We have another market voice, Mahantesh Sabarad, Head of Retail Research at SBI Securities, who's joining us on the show right now. Mahantesh, good afternoon, and thanks for taking the time out. Let's talk about the large caps. Let's talk about just the indices and the stocks which are a part of the indices right now. At 12,000, well, some would argue these are heady valuations, but again, these gains are not necessarily broad-based, even in the Nifty 50. What's your take on some of these large cap names, and how are you addressing them?
So we've had a very good year as far as large caps is concerned. You will notice that of all the subsegments that are available in terms of sectoral indices, the large caps, the Nifty primarily, or let's say the Sensex primarily, have outperformed the better known rivals in the form of other indices. That's simply because the large caps are the ones who are resilient to any form of shocks that come either in the economy locally, domestically, or shocks that come in through the mechanism of global trade and so on and so forth. So we've seen that play out. In terms of valuations, which you refer to in terms of heady valuations, I don't think the valuations are very heady at this juncture. You have ample growth headroom available for most of the stocks, so valuations are not challenging at this juncture.
Ajak, that's the bank Nifty, and if you see, sometime during mid-afternoon, you just saw this vertical drop in the Nifty bank, and if you pull up any member of the Nifty bank, the graph is so similar. You have HDFC Bank, ICICI Bank, Axis Bank, IndusInd Bank, all of these names had a similar vertical drop, where the bank Nifty actually had almost a 1200 point intraday swing in today's session. It was down closer to almost 2%, from which it recovered, and in the early morning trade nonetheless it was still trading with early morning gains. So it's been a pretty wild day for the Nifty bank. Mahantesh, what have you made out of what's been happening with the Nifty bank? Is it starting to look a little over-owned now?
No, not really. I think what we are seeing, and we have seen this even in the past, that there's been a distinct, diverse reaction seen from the private banks and the PSU banks. So that is what is playing out even this time around. As far as the dip today is concerned, quite frankly, it seems to be an unexplained dip, because the dip happened and we have recovered partially from that dip. So don't really, want to attribute any particular reasons for the dip today, but the bank Nifty has been steadying over the past year. It's been actually growing, I would say, and part of the reason is that there has been a ample change visible from the investors' point of view in terms of their take on PSU banks. The PSU banks were earlier avoid kind of stocks. Now they no longer are avoid stocks.
Okay. All right then, Mahantesh, let's also talk about the consumer sector. Well, it's been well documented that there has been a little bit of a moderation in the quarter gone by, and a lot of managements of the at least FMCG companies are suggesting that they'd like to wait for another quarter or two before deciding this was just a blip or this is genuinely a slowdown in terms of demand. Staying with the staples, what's your view here? And if you can talk about stocks specifically in the FMCG sector, which may not have run up as much or which may still look reasonable to you.
So let's look at what happened in terms of FMCG over the past year. The demand growth was pretty strong. Most of them were posting volume growths closer to the double-digit number, or in the range of upwards of 8%. Some were even posting better numbers than that. That was coming on the back of the previous year's low volume base. That low volume base was created because of demonetization and the GST rollout effect. That effect is now out of the picture, and therefore what we are right now seeing is the demand slowing down on an already high base built up in the previous quarters. Plus, additionally, there is an element of stress or distress that we are seeing. You asked me about stock specific in terms of what should we look at staples. So I think what we noticed this time around was that, particularly in the case of ITC, is that they withstood the general slowdown that we have seen in the FMCG side, and I'm referring to their FMCG business. The exit rate, growth rate at which they exited the fourth quarter was 25% YOY, if I'm right. That's a pretty fairly strong number that they posted. Cigarette business is doing more or less steady. it's a cash cow kind of situation for them. So ITC is something that we think can do better and remains a standout among FMCG's companies thus far. There were particularly other companies who have given strong guidance as well. Let's look at Galaxy Surfactants as one of them, for example. They posted superb results this time around in the Q4, quite unexpected, and the stock reacted also post the results quite sharply up. I think there's more headroom available for growth ahead.
Since you spoke about ITC, the stock actually trading at the lowest point of the day. Remember, Dr. Harsh Vardhan, who is the Minister of Health and Family Welfare now, I mean, there are concerns because in the past he's been vocally pro increasing taxes for cigarettes. So whether this works detrimentally for ITC is something that we'll have to wait and watch. But the stock nonetheless is trading at the lowest point of the day. However, the other pocket that has been witnessing a big drag, and this drag has been a prolonged period of pain, is the auto space. Mahantesh, you've tracked this auto space closely. Is there any light at the end of the tunnel?
I think there is. Autos are cyclicals, as you are aware. They go through this periods of high growth and periods of low growth. But in the past, we have never seen negative growth rate of a sustained nature playing out for several months. This is the first time we are seeing it in several years, and therefore it's of concern. But like I said, that there is a silver lining that one can see as we go forward, because we are, as a country, structurally changing from Euro 4 norms to Euro 6 norms. We are jumping one norm and going directly to the Euro 6 norms. In this process, you will have a lot of changes coming in. You will have a lot of new products coming in. You will have a lot of old products going out. You will have what is also classically called as pre-buying effect that will come in. That pre-buying effect probably will come in the third quarter or the fourth quarter, and therefore that is why I say there is a silver lining here for the automobile stocks. As far as investors are concerned, the stocks have also dipped. They have actually underperformed the broader markets. Most of the auto OEMs have fallen on a year-on-year basis, and therefore they present good entry points when it comes to getting returns ahead. So if you have growth coming in terms of volumes, auto companies should be able to therefore deliver better profits and earnings into the next year. And on the back of those earnings, we should see stock prices recover coming off the falls that they have seen.
And Mahantesh, is there a distinction that you're making right now between two-wheelers and four-wheelers, or do you think that they both sail mostly in the same boat?
So I think the better one to look at are the two-wheelers at this juncture, because both these products, four-wheelers and two-wheelers, get financed. The finance penetration is actually deeper in the case of two-wheelers relative to the four-wheelers, and that finance penetration requires a lot of NBFC-led funding available, which we saw in the past few months now being constrained. So if you have the NBFC crisis kind of resolved through whatever interventions that the government deems fit right now, and therefore you have also a low interest rate environment prevailing with let's say the RBI looking at rate cuts, then you will have more finance reaching out to potential customers, and that could jumpstart the two-wheeler demand in a much faster manner relative to the four-wheelers. And therefore two-wheelers should be looked at more aggressively from the investor's point of view relative to the four-wheelers.
The other pocket is obviously the oil and gas space now. Most of the big numbers are out, and we've seen the downstream companies doing relatively better this quarter. Upstream companies not so much so. Probably ONGC was a bit of a disappointment. What did you make out of the numbers and the variability in crude oil price and the volatility that we've been seeing over the last few months? Do you feel that could affect detrimentally going forward for most of these companies?
So I think we have made a clear distinction here in the oil and gas space: refineries or the downstream oil marketing companies versus the upstream oil producing companies. This distinction has been been there in the market by most participants, and they understand this aspect really well. The upstream companies have not done well even at times when the crude oil prices have been going up. You singled out ONGC. I think ONGC also had its baggage of problems when they bought HPCL through the divestment mechanism that the government exercised last year, and that has straddled it with certain elements of debt, or a lot of cash got actually utilized for that purpose and went out of ONGC's balance sheet. It has also affected their production capabilities. To be fair to ONGC, while they are making efforts, their pace of oil discoveries and the pace of growth that they are achieving in terms of oil production is quite low. And that is something that investors don't really like, and therefore you see the stock tumbling or you see the stock not performing. Oil marketing companies have a different play. Irrespective whether the crude prices go up or down, they have a mechanism of a pass on that is available because some of the oil products are free. There is a little bit of intervention that comes in from the government, but I would say it's not overwhelmingly large. So that pass-on mechanism tells you that they are reasonably protected when it comes to their earnings growth ahead. There would be bouts of certain compressions in margins in certain few quarters, and which will be reversed in the following quarters, and so on and so forth. So oil marketing companies look more stabler relative to the upstream oil companies.
Okay, Mahantesh, we'll leave it at that. Thank you so much for joining us and taking the time out, speaking to us on Bloomberg Quint this afternoon. But, let's also address the economy a bit. Now, the fourth quarter GDP numbers may not bring a smile to the new finance minister, though with the most macro indicators pointing towards further moderation in growth. Pallavi Nahata sums up what we can expect this evening.
GDP growth is expected to moderate further in the January-March quarter as investment and consumption demand show signs of moderation. A Bloomberg poll of 42 economists have estimated GDP growth at 6.3% in the fourth quarter. The range of growth estimates is wide and stretches from a low of 5.7% to a high of 7%. GVA is expected to grow by 6% according to 25 economists polled. For the full financial year, GDP growth is estimated at 6.9%, a tad bit lower than 7% estimated by the CSO in the second.
All right, we just get back to that, but need to bring in industry veteran Mr. A.M. Nayak, who's joining us right now on the phone line with a quick reaction on the portfolio allocations. So, Mr. Nayak, thanks very much for taking out the time. What have you made out of the design of the ministerial portfolio allocation? Are you happy with it?
Well, I think it's not a question of how happy or not. How will they finally perform? There were a couple of surprise. One was the finance minister is a surprise appointment, although she's competent. But I don't know. We'll have to wait and see how well the finance performs. But it's a very, very important portfolio, very important. So, home I had expected. There's no problem. Defense, Rajnath Singh expected. So, foreign minister, I think is a surprise for almost all. But he was very competent foreign secretary. So, he will do well as a foreign minister. On the whole, otherwise it is very well balanced.
Mr. Nayak, now the focus obviously shifts to priorities in various different segments and various different sectors. But for the finance ministry, what according to you remains to be the priorities to be tackled by the new finance minister? I mean, most of them saying now farm distress starts to take center stage.
Well, first and foremost, they must do with what I expected, like it was in case of the Vajpayee government, the Ministry of Divestment. And there is a huge amount of resources required. They have made a lot of commitment to farmers' community, to the social sector. And of course, all the sectors we need huge investment. Infrastructure, will need a tremendous priority because it creates also, apart from multiple economic value add, it creates a lot of jobs. And therefore, I think mobilizing resources is a major thing. One of them is the divestment of stress resources or divestment of public sector undertaking, or for that matter, I would say there are companies which are in tobacco or which are in consumer products. Government has no business to be investing in those kinds of things. And they can mobilize few 100,000 crores. I know for sure, few 100,000 crores. And that will be, in a way, passing with the resource requirement for all the priority sectors that we need to really work on.
Mr. Nayak, would you say that that is only restricted to stressed assets, or would you believe strategic divestment would be an overarching theme for Modi 2.0, not just stress but even otherwise?
No, I said strategic sector, they should divest. Not just the stress assets. That will be a peanuts. I mean, small thing you will get. But strategic divestment is where they will get a lot of resources.
And this probably will give them a little bit more of budgetary headroom as well, because there will not be too much of a fiscal strain on them, even if they want to make those big ticket, funding pushes for the mainstream industries.
Yeah, I agree with you. I think the real issue is going to be where will they get resources from to be able to give all the priority sectors the required resources. And the liquidity in the market is very tight. They have to really release more liquidity through Reserve Bank policy decisions. And the private sector, almost 60-65% of private sector has created NPAs, and they have to be brought back into health as early as possible. And otherwise, the private sector investment has almost dried up.
Yeah, and even public sector investment without compromising on fiscal prudence. Mr. Nayak, anything that you're expecting, particularly from the defense segment now, that is your primary focus?
Number of tenders which were half done, or rather not gone ahead because of resources. Again, it is because of resources. Number of them worth maybe few 100,000 crores. They all, like we talked about, nuclear submarines, some are pending. The conventional 6 submarines worth more than 60,000 crores are pending. Missile program is pending. The platforms and the floating docks for helicopter landing is pending. So there is innumerable projects which are held back because of resource availability. So all of them have to really start moving, and for which you need resources. Just imagine, high-speed railway would not have come up but for 100,000 crore financing we are getting on a soft loan basis from Japan. So as Harbour Link project from Bombay to New Bombay would not have come up but for the Japanese financing. So I think we have a real problem of financing all the infra projects and the priority sector projects, partly which could be made by divestment, including of some of the priority sector, but there is no need for them to be in government sector because there are already a lot of private sector who are already in that business. And then, of course, the liquidity improvement, so that private sector will get some money, at least those who are in a position to borrow. And some of the retail sector also will come up. Consumer sector will come up. NBFC will come back to health. NBFC, I don't think there are thousands of NBFCs. We have to really take a priority and make sure that only 50 to 60 really healthy NBFCs are really allowed to be financed.
Mr. Nayak, Nitin Gadkari gets the MSME portfolio. Speaking to financiers across seems to suggest that that sector is in a bit of a turmoil. Right man for the right job. He's done a fabulous job with the Road Surface Transport Ministry. Is this the thing that was needed for the MSME space?
I can't understand what is that transport sector.
So I'm saying Nitin Gadkari did such a fabulous job with the road surface transport sector. He's now been appointed as the minister for the MSME portfolio. Right man for the right job, you think? Because that space seems to be in a bit of pain.
I think it is not a question of right man for the right job. I mean, majority of the cases, the minister and IS officers are generalists. They are not specialists. It's a question of willingness to really move dynamically forward and the resource mobilization to make sure that you can move dynamically forward. And the minister concerned, who did a fairly good job on transportation sector, I'm sure will try to do as well for MSME, and things will move up.
All right, Mr. Nayak, it was a pleasure chatting with you. Thank you so very much for joining us on Bloomberg Quint.
Thank you. Thank you. Bye.
Bye. All right, that was Mr. A.M. Nayak there with his expectations of what should be priority and what focus should be done. And according to him, funding is key for every sector. I mean, you mobilize funds, you start looking at strategic divestments, and without getting into a lot of fiscal strain, and that's the way to go, according to Mr. Nayak. Markets for themselves still down under in some amount of pain. For the Bank Nifty, at least, we're down about 0.75%. 11,897, I think, is where the Nifty is trading at. So that's down about 0.5% as well. Pritesh Mehta of Yes Securities is joining us on the show right now. Pritesh, very good afternoon to you. What would you do with the index now under 11,900?
Good afternoon. Now see, after a big rally, the market will go into a hurdle. It will face resistance. This is a normal cycle phenomenon of every bull market. So traders should not be getting confused or making a mistake of creating positional shorts in the market. See, over the period of last 3 weeks, we have done extremely well after hitting the lows of 11,100. In fact, we have been right, and predicting the upside. But we must understand that all the good things eventually comes to an end. With today's onset, this week's in fact onset of volatility, there is a possibility that index could begin a process of consolidation between 11,600 to 12,100, or a retracement back to the previous breakout zone of 11,600. So I think market cannot move in one direction all the time. We are bound to get in road, we are bound to face bumpy rides going forward. So I think we should not be getting too much excited, too much worried or concerned by the fall which we have seen in today's trade. See, in today's trade, Nifty made a peak, attempted a peak which was the level which was created on the outcome of the election day, and we have seen index struggling around that mark. On 2 occasions, we went about 12,000, we came back lower. So yes, there is a presence of 3-digit GAN number, which is 12,100, which is holding the index. So I think this is the time we should not be focusing on the levels on the upside. Rather, we should be concerned about putting strict stop losses, because I think there could be a process of consolidation taking place in the index.
Okay, Pritesh, so while you expect consolidation in the benchmarks, what about stocks? Does anything look interesting to you there?
I think that the kind of setup we are in right now, it is always we should be focusing on the leaders, and the way the market has come off, ICICI Bank, HDFC Bank, HDFC, Reliance, these counters took a hit in today's trade, but I think we should be looking at buying opportunities in these counters if you are having a positional view in this market. So this is our bet. Apart from that, there are some ideas which I have worked out. One of them is Godrej Consumer Product. I think it's a classic example of a stock which is going through bottoming out pattern. In the second week of May, it hit a low of 625. Thereafter, it commenced a process of consolidation at the bottom. The base building, this bottom building pattern lasted for almost a month, and thereafter, in today's trade, it witnessed a breakout from a downward sloping trend line. Also, a small consolidation breakout. So I think this counter is set for a big move towards 760. And second recommendation is buy on HCL Tech. See, now market is finding it hard to find its footing around the all-time high mark, but IT index is doing something else. For the week, In this chaotic time, this index is up by almost 4%. And from this space, we like HCL Technology. The stock has been consolidating at the bottom for quite a long time, near to its GAN number, and thereafter it has given a good breakout in today's trade. So I'm expecting a move towards 1200.
Okay. Stay on with us, Pritesh. We'll come back to you and get some more chart checks going. But bringing in Anand Tandon, independent market expert, who's joining us on the show right now. Anand, what are you making out of the recent rally that we have seen? Once again, tried to take down the 12,000 mark, but unsuccessful at that in today's session. Do you believe that you might land up seeing some amount of consolidation now?
Well, I don't know how to look at the near-term moves. I mean, the technical analysts say that, it's possible that a couple of 100 points more is possible on the upside. If you look at the fundamentals, I don't see any reason for it being here or even higher than here. The reality is that, both globally as well as in the domestic market, we have lots of headwinds. And they are growing on both counts. So domestically as well, the expectations now with the new government are sky high, and money will be hard to get. Which will mean that given the track record that we've had of the existing government, you should see a whole bout of belt tightening for people in the capital markets. Don't be surprised if you see, return perhaps of estate duty or wealth tax or any of the above, none of which is good news for the market. There is already a slowdown in terms of the consumption growth, etc. And we have an immediate problem of liquidity facing us. And on top of that, we have Mr. Trump in the US throwing new problems in international trade every day. So, with all of that going and the valuations being where they are, I don't particularly see any reason why there should not be more than consolidation. There should be an actual downward movement. But the market has been extremely resilient, and therefore we just have to move with the trend.
Okay, Anand, so, over the last 3 odd months in the run-up to the election and even after that, we saw your benchmarks run up 10%, but the constituents were essentially the banking stocks. But the question really is that this gain, this rally that we've seen is very, very narrow, and it comprises perhaps of no more than 20 odd stocks, even in the Nifty 50. If you leave these 10 to 20 stocks aside, how are you looking at perhaps the relatively broader markets of 100 stocks beyond this in terms of valuations, and if at all do you find any pockets of value here?
Well, there are segments which have become a little less expensive, obviously. Mid and small cap valuations are a lot more attractive today than they were, let's say, a year ago. But that said, from an investment point of view, if you're looking at 3-4 years, I think it's a kind of that should be the place one should be looking at. And I can see some areas, if you were to look at it sectorially, for example, hospital has been an area where there are some issues. The expectation being that some of the margins may come under pressure, but I think that's more than reflected in the price. If you look at the kind of performance that they have been, most of the companies in the sector have been delivering, I think the market is somewhat underpricing that. Similarly, with medical diagnostics, I think there may be some growth left there. Consumption to some extent has eased off, so some of those companies which have come down may be a good place to look at on the longer term basis. But I would emphasize the longer term basis because there can be, and there should be, in my view, a fairly sharp correction from where we are before we were to look at it going forward, which will mean that even those companies where the valuations are relatively cheap may also suffer from that. So if you leave the macro aside, I think to answer your question in a short manner, public sector banks, cement, hospitals, medical diagnostics, and some of those sectors are perhaps ones that one can look at.
All right. I just want to take a look at NCC now. I think the stock's down about 17%. It's been under tremendous pressure since the start of the trading session, actually. It's been on a gradual glide downwards after the AP government has cancelled some projects sanctioned by the previous state government. Remember, NCC gets nearly 30 to 35% of its order book from Andhra Pradesh, though the management said that they haven't received any communication regarding any of these cancellations and that there wouldn't be any material impact if at all some of those cancellations do come about. But remember, just 2 or 3 days ago, NCC reported a really strong set of numbers. Its revenue grew about 41% year on year. EBITDA margins came in strong at 11.7%, and that is the time you actually saw the stock move up almost 10%. So, some amount of news-based reaction as well, and some amount of profit taking, considering that the stock has anyways run up quite significantly post its numbers. The stock there is down about 16%. A quick word, Pritesh, on NCC. Do you track this one at 97 now?
Now see, back in the month of May, second week of May, the stock made a low of around 88. Thereafter, it started its journey of going higher, going above 120 mark. But thereafter, I think what we are seeing a classic retracement taking place. It will come back to its previous low, and around that also some GAN numbers are placed. So I think it is going to take some time. We can see the stock going back to 90 odd levels, and I think from there on we have to see how the stock performs. So I think for the time being, there could be some more downside coming in.
Okay. Anand, I want to stick with the sector specifically because in light of certain commentary coming in from the new Chief Minister, and you're based in Hyderabad, if you have any idea about what's going on, that's one thing. And secondly, your outlook when it comes to the road and infra space in general, considering, well, we also have incidentally a continuation of portfolios with Mr. Nitin Gadkari coming back.
So, one of the things you have to keep in mind is that this is a sector which will always be affected by government policies and things like that, because you are dealing with the government almost all the time. That said, from what I understand, the management of NCC is quite close to the new dispensation in Andhra, so I don't think that there is any issue in terms of relationship there. And therefore, whatever new projects come, I think they will have as fair a chance as any, if not better than most, in terms of being able to bid for and get the projects. I think the real issue is that the management today seem to have guided for a flat top line for the next year, which has somewhat spooked the market because you were expecting to see at least a 10%, if not more, top line growth and at least a 15-20% growth in the bottom line. You have to remember that one of the key issues with infrastructure has been that in a project you'll have your money being retained, and when you're making 4% net margin and the money is being retained for a long period of time, your cash flows get stretched. So that is something that one has to look out for. After this correction, I think on a fundamental basis, one could argue that NCC is not looking very expensive.
Okay, Anand, in that case, let me also address what's going on with consumption here. And well, we all know about the relative slowdown that we've seen, which is indicated in the volumes. But my question really is that where do we go from here, and would you want to wait before you put in and allocate some money in some of these larger FMCG names specifically? Because the correction has been there, but it hasn't been significant. How are you viewing the space, and what would your take be here?
As I mentioned, the correction is been there, but it's more been sideways rather than downward, except for a few names where the stock have actually corrected quite a bit. There are two issues here. One is, of course, the fact that there has been a slowdown in demand, but the more important one, to my mind, is the fact that there is a structural shift happening for many of the FMCG companies, which is that the private labels are becoming more powerful in the organized retail. And that is something that will put a downward pressure in the margin going forward. Yes, there is a very large market available, and yes, the old brands have a lot of brand pull. But I think to ignore the kind of inroads that are being made by the private labels is, I think, missing the wood for the trees. So going forward, I think the valuations that generally the sector is trading at, first of all, it's at a huge premium to what it used to trade at traditionally. To some extent explainable by the fact that it's one of the few sectors which have been showing growth, and also the cost of capital has come down overall. But I think that's more than affected in the price. And as I said, going forward, you will have a problem with this, with the private labels, both in the in the clothes and so on, but also in the food area. Net, I think it's still too expensive. You need to be in the sector as a portfolio allocation strategy. But I think right now being underweight should likely pay you reasonable dividends.
All right, Anand, we'll let you go on that note. Thank you very much for joining us. Appreciate you taking out the time. All right, first few visuals of the new Finance Minister, Nirmala Sitharaman, there at North Block. Lots of people there ready to congratulate the new Finance Minister. We'll keep those visuals coming in. But a long, ready list of things to do for her already set. Her task is cut out pretty well right now as she steps into her new job. All right, moving on, we've got Repro India. They recorded a steady growth in the March quarter, but the margins contracted to 11% from 15% earlier on. To help us understand the factors at play here, let's get in the Executive Director, Mr. Pramod Khera. He's here with us in the studios. Mr. Khera, thanks very much for taking out the time. So while everything else looks okay, what led to the drop in margins?
Well, you need to understand the composition of the businesses that we are in. So there are two businesses. One is the printing business, which has been the old traditional business. And we are now growing the new business, and which is becoming significant. It's last year, the last financial year, it's 28% of our overall revenues. However, that business is still not adding to the bottom line in the sense that we have broken even at EBITDA level. So the old business is profitable, and since the composition of the new business has increased compared to the previous year, the margins naturally have dipped.
Does that change anytime soon?
Definitely. I mean, once we achieve the now from last 2 quarters of the previous year, we broke even at EBITDA level and made slight profit. So that trend is going to continue, going to increase, and over a period of time, we'll see it contributing more and more to the bottom line of the company.
So you'll scale back to those 15% levels?
It should happen. Yes.
All right, so Mr. Khera, if you could tell us a little more about this business, what we can expect in the upcoming year, the plans that you have in terms of scaling up, and of course, at the end of the day, profitability as well, what it may look like towards the end of the F5.
Sure. So this business that we are in, the new business, is actually a print-on-demand business.
Yes.
So we are selling books on various e-commerce channels like Amazon, Flipkart.
Yeah.
Only thing is we don't hold inventories.
Right.
When we get the orders, we print the books. So we we aggregate the titles, the soft files from the publishers. And that the content repository that we have, we access the files from there and we print when we get the orders. So the driver for growth are going to be more and more content that we're able to aggregate and we're able to get from the publisher. So that's one which we are focusing on. And over the next couple of years, we should see a quantum jump in the content that we have. That's one part of it. Other is that in order to really be able to sell to a larger number of consumers, we need to be present in more locations in the country. From Mumbai, we were able to cover maybe around 30 to 40% of the country for deliveries within a day. So we have plans of setting up a print-on-demand unit in Delhi and one in Bangalore. Once that happens by end of this financial year, we should be covering more than 80-85% of the PIN codes in the country. Okay. That itself will give a boost to our sales, even from the existing repository that we have. Right. Plus, once we keep adding more and more titles, that will grow the overall revenues. And like I said, going forward, once we reach a certain scale and where the utilization of the capacities that we are installing reaches a level where it is efficiently being utilized, we should see a growth in the bottom line.
Right. And we have all the capital expenditure for the Delhi and the Bangalore units out of the way, or is there some still left?
Yeah, no, so we have adequate funding available. We already raised some funds through equity infusion. Plus we have our internal accruals which will fund that. So totally around 30 crores is needed and we have that money.
Okay. And that will essentially at some point be the majority of your business in terms of contribution to the top line.
That's right.
All right.
You said that all of these things are going to ultimately translate into a boost in terms of your sales, revenue, EBITDA margins picking back up. Give me a timeline, Mr. Khera. I mean, when we're talking about growth in sales, 10%, are you going to take that as a quarter-on-quarter growth rate in revenues as a norm, or you see that picking up further?
Further, more than that.
How much?
So the thing is that...
and when? How many quarters down the line?
So I would say 18 to 24 months is the timeline that we're looking at. However, as a company, we have a policy of not giving any forward-looking statements, so I'm not able to give exact numbers.
But you would have a backhand calculation of how much all of this adds up.
So like I said, by 18 to 24 months, we should reach a scale where we should be able to see decent profitability coming from the business.
So CAGR growth up until 2021 would be how much?
I will not be able to give you an exact number.
Okay.
There.
All right.
All right, Mr. Khera, also that your total debt, if I consider your short-term and your long-term debt, that has of course come off significantly. Well, given the kind of expenditure that you may have in store in terms, keeping in mind that expansion, how would you think the debt picture may look like towards the end of the financial year?
Well, to fund the equipment, there could be some debt, long-term debt, which we take. However, the short-term debt will come down, because the new business, it doesn't require any working capital.
Right.
Right. In fact, it has got negative working capital.
Okay.
So, and the old business, we're not growing it from the current level. So, the current levels of working capital is more than adequate to.
So, what is the plan for the old business? Are you looking to? What are you planning to do if you're not planning to grow that?
No, so that business is going to be strategic in nature, even for the new business, because along with that business, we will be able to offer the complete range of services to the publishers, right from printing, say, 1 lakh books or 50,000, 10,000. That can be done from that the plant that we have in Surat. And then we have our print on demand, where we can print 1 book, and we can also print 1,000 copies.
But a bigger contributor to the revenue is the old business, right?
Currently, yes. But as I said, 28% is the new business, and that is going to keep on growing.
But then if you don't have any plans to grow the old business, how is the incremental growth going to come? I mean, while obviously...
From the new business.
From the new business. All right. No, Mr. Khera, I'll just go back to my question on debt. That means that do you expect the debt equity ratio to remain reasonably stable or the same, and are you comfortable with this debt right now?
Yes, in fact, it should improve going forward,
okay.
yes.
All right.
All right, Mr. Khera, thanks so very much for joining us.
Thank
really
you.
appreciate you taking out the time. Mr. Pramod Khera there talking about Repro India and how its performance has been for Q4. Print on demand business. Likely to add more in terms of revenue contribution from the current 28%, and over the next 18 to 24 months you can see a substantial increment in overall growth coming in from sales, kicking in from both businesses. The stock though is down about 2.8% at 594 odd rupees. Taking a look now within the broader market space as to what's been the big movers of today. Remember, Edelweiss, the stock over the last few days has done really well, and once again the last few minutes of trade has really propelled the stock higher, now above 200. If you just pull up the last 1 month and the last 3 months performance of Edelweiss, the stock has really seen, look at the graph of the last 1 month, from levels of I think sub 140, the stock is scaled 45% now to somewhere around 200 for an Edelweiss at this point. Would you take a trade here, Pritesh, on Edelweiss?
Now see, the stock has already rallied by 11% this week's trade. We are talking about a stock in recently, just couple of, I think 4 weeks back, the stock was languish around 130. From 130 we have seen a rally towards 200. This is the right time to get into the stock. I would wait for a dip, a move back to 185, 190 odd levels before we can go and buy.
Okay, well, I mean, yeah, there's no doubt about the fact that Edelweiss has had a massive run, and it continues to go from strength to strength, as is the case for a whole host of other NBFCs for that matter. But there is yet another stock which also is up and about, and I want to talk about Berger Paints. The thing about Berger Paints today is that, of course, leaving aside the fact that we've seen a massive surge in its open interest in today's job trade in this futures and options space, it's currently trading at intraday highs, up 9%. Besides that, what is also important is actually moved and they made that very sharp up move above its very crucial moving averages. If I'm not mistaken, the 200 daily moving average is one of them. This usually is taken, at least by those who study the basics of technical analysis, as perhaps a positive move. Currently at 327, well, this move of today has been pretty sharp, and in fact that has actually led to, well, okay, so on a 3-month basis into the positive zone. So Pritesh, let me take you up on Berger Paints as well. How would you address this one? What would you do with this right now?
Now see, we need to understand that first of all, market is trading around 12,000 mark, and we have seen it's struggling to clear that convincingly. And you know, we have to be extremely diligent in what kind of stock we get into. This stock for quite a long time, in fact, you know, for last 1 year, the stock has been stuck in a trading band. You know, 350 on the upside and 280 on downside. It is unable to break past this trading band, and currently we saw a rally. Today we saw a rally of 9%, 10%. For the week it is up by 6%. Getting in the stock at this time won't be the right approach, because market is struggling to break those levels. And if that breakout does not take place about 12,100, you know, this kind of stock would struggle to live up to that earlier movement. So I think we should wait for a dip. I think it will be a while before this stock, you know, breaks out from this 1 year long trading band.
All right, that's Berger Paints for you, 9% higher. Remember, it reported its numbers yesterday. Profits were up marginally by about 5% came in at about 111 odd crores with a 13% increment in revenues. Margins saw a slight bit of a squeeze, but came in almost at par with 15.42 that they had recorded in the same quarter last year. Today, you're seeing a bigger reaction to the stock. We're going to take a very short break, but as we slip into the break, here are some comments on how to play the infrastructure space as the new government takes charge. We spoke to Aditya Narain of Edelweiss sometime back in the morning. Here out his answers. Take that break and come back.
See, I think for a start, do remember that there's been a fair amount of infrastructure spend that's been going on in any case. So while I think it's there upfront in the manifesto, I don't know if the delta will necessarily be as much as the pure hard number suggests in terms of spend, because you can push it up a certain amount. How much can you accelerate is one part. So that's one. The second thing is, I think you have to play with the biggies, whether it's the construction space, whether it is the L&T space, which are conglomerates. But I think what has happened with the economic cycle as it goes up is the big are in a privileged position in their capacity to take on projects, in the efficiencies that they bring, and quite honestly, in the risk people who are giving out contracts are prepared to take. So I think in this whole space, whether you play the larger construction companies or the smaller ones, I think the story lies with the largest amongst them rather than going lower and lower. So I think that's one bit. This time, I think the infrastructure story will also play out a little differently, because the nature of money that's going to come into the system is going to be different. You have these big asset holders which are coming in at a relatively early stage, you know, guys who are buying out these assets. So unlike a lot of guys earlier, construction companies who took on developmental risks, I think that is going to be out of the equation. So that's going to be good for valuations relative to where they are today. And there'll be, you know, the valuations might have been higher the last time around, but then they were paying for the wrong thing, right? They were paying for developmental assets. If people are going in and saying we're going to take risk assets by buying roads, I think that's moved to the yield side. If an equity player is playing that, people will want to stay away.
Okay, interesting thought. But your answer prompts me to my next question then, Aditya. Are you, for the next, not necessarily the next 6 months, the next 2 years, are you playing for the delta? Or are you playing for continuity of growth? What is the bigger bet that you're taking?
At this point in time, we are playing for two things. One, a little bit of continuity of growth, right? And secondly, where will the delta come? So you actually raised this issue about infrastructure investments being very large in the manifesto. Something that was smaller, but I think was equally prominent, was the fact that I think you're going to get more support from these income support kind of schemes like the PM Kisan, okay, which they said they'd actually expand. I actually think a lot of the fiscal stimulus will come in that space, because I think the die has been cast there. I think in the last budget, you actually gave out some money. It probably did contribute to the extent of the political win. I think that's an ask of the economy and of the voting population. And I suspect you're going to see more such schemes come through, more such spends come through, rather than necessarily all the fiscal effort going towards the infrastructure side. So I think, so if you get me, the traditional response to a new government is money in projects and large investments. Some of that will happen, but I think there'll be probably more that happens in income support schemes. So that will potentially change the dynamics of the growth that you get. See, the multiplier effect of that is great. Money going straight into banks, leading to consumption, leading to risk appetite, leading to businesses putting in money, right? The impact is very, very direct. and it goes to an individual so you can actually get that sense upfront. We think there's going to be more of that rather than necessarily the traditional investment bounce back. So to that extent, from a portfolio perspective, what we would think is that we should actually play a little bit more of the staple space, which is a kind of a contra view, but you play that because money is going to go into the hands of a lot of individuals, and that's going to support low-end consumption.